my competition.
Moving on, the Reserve Bank of India has issued a discussion paper proposing stricter rules on provisioning for loans. The paper proposes that banks must start providing loans when they sense the first sign of trouble and not after the loans have turned into non-performing assets. Ritu Singh joins us now with the details. Ritu, what does this essentially mean for banks?
Well, there's a new approach for provisioning by banks which is in the works that is going to align Indian banks with global standards. Now, NBFCs have already moved to this expected loss model, and now RBI has floated a discussion paper on the same for banks. Now, currently, if you see, banks follow an incurred loss model where they make provisions only once repayments are delayed or not paid. But now, RBI has proposed that banks start providing as soon as they expect any kind of loss. Now, under this approach, banks have to classify loans in 3 categories. Stage 1 will mostly be all your standard assets. Stage 2 will be loans which are seeing some potential stress, and Stage 3 will broadly be loans that are in default. Now, banks can design and implement their own models to assess how much they need to provide in each of these 3 stages, but there will be a minimum provision requirement set by the RBI. These models will also have to be independently verified, and banks will have to make disclosures on the methodology as well. Now, in terms of the transition to this, firstly, comments are invited on this discussion paper by the end of Feb, after which RBI will come out with final guidelines. But the impact is not going to be immediate because banks will get at least 1 year for implementation, and a maximum period of 5 years is proposed to phase out the higher provisioning and avoid any capital shocks to banks. Now, in RBI's own words, it expects the potential initial impact of this application on banks' capital to be very significant, and broadly the sense is that provisions will rise. Now, CLSA, for instance, expects a limited impact on private banks, but for public sector banks, it says there's a need to build capital buffers. Macquarie believes provisions could be much higher because the probability of default has been high in the past 5 to 10 years, and the impact will be starting to be felt from FY26 onwards. Morgan Stanley believes that the potential impact is going to be manageable, with larger private banks better placed than the others to weather this, and Jefferies also holds a very similar view.
Right, thank you, Ritu, for that. Now, Reserve Bank of India has said that the likely